Welcome, my friends. It's great to see you. Ken and Zach, I don't know how you guys made it in here so quickly without me even having shared the link, but welcome to the stream. It's great to see you. Absolutely, my friend. I am definitely glad to be here. There's no place I would rather be. Let's put it that way. The opportunity that's been afforded to retail investors here by the greed of some of these hedge funds and market makers is astronomically massive that's even an understatement at this point. The things that we've seen, the 1,000% run-ups and the massive stock price crushes that we've been through is the thing that makes and creates legends. Chancellor Walls says, love you, boss. Good to see you. Cheers, my friend. It's great to see you as well. Thank you. Yeah, Paul, 1 o'clock live stream. I'm wide awake for it and pumped. Hey, SMK, Aaron, Kirsha, it's great to see you, my friend. Good morning to you and all my European friends. One Plastic Life. And Quant Trades, what's going on, buddy? Yeah, huge shout out to all you Lit Exchange investors, to all my fellow founding members. You, my friends, are going to make history. You already have made history. But let's put it this way. When everybody else starts to jump on the bandwagon, you're going to be making people wish they were in your position. William, good evening, my friend. Andrew, good morning to you in the UK. Manifest Moon and Dana. Dana's just getting ready for bed. Talk me to sleep, boyfriend. You got it, hon. No problem. I might bore you. I might excite you. We'll see what happens here. Thank you, Zach. Zach says congrats on 500,000 on Lit Exchange. Yes, sir. We have already officially cracked the $500,000 mark investment from retail investors, and that makes me absolutely ecstatic. We are very close to launch. I can taste it. It is almost upon us, my friends. Let me know what you guys think of my current sound setup. I turned on a new noise suppression filter. I turned on a new gain filter. So my mic is turned down significantly, even though the gain is much higher right now. The background noise, even though my kids are sleeping, all the other TVs are off, everything is pretty quiet in the house right now. Let me know what you think of it. I hope it's not too obnoxious and not cutting out part of actual verbiage and speech. Kersha asks, when Lit Exchange in Europe? Very soon, my friend. First, we launch here in the States. Then we're going to, in here in North America, then we're going to see you over in Europe. You bet. You bet. I'm more than ecstatic for that. Because let's put it this way. You Euro apes have even shittier options as far as broker-dealers go than here in the States. CPOS, perfect volume and clarity. Kersha sounds good, loud and clear. Brian, thank you, ladies and gentlemen. I really appreciate that. That helps me a lot. So that way I know that you guys are actually able to enjoy the content without struggling to hear. Because I know if you're driving, you got to crank the volume. You got to put the earpiece in, the earbuds, and make sure that you can hear while you got a lot of background noise going. So I'm really happy to see that. Thank you, Texas Pete. All day, my friend. Check out this hilarious article that popped up today from Market Watch. It says, meme stocks were fueled by Roaring Kitty and Trump trades this year. What can we expect in 2025? Cheers, Dana. You're too kind. The return to social media of Keith Gill, also known as Roaring Kitty, thrust original meme stocks AMC and GameStop back into the spotlight in 2024. I would like everyone to know that there is a new SEC operational status update on the U.S. SEC website, sec.gov. And it says, in the event of a federal government shutdown due to a lapse in appropriations, the SEC's operating status will change concurrently with the rest of the federal government, in accordance with the agency's plan for operating during a shutdown. As that plan contemplates, we are currently preparing for a potential shutdown, with a focus on the market integrity and investor protection components of our mission. Let me know if you guys in the chat feel protected by the Securities Exchange Commission. Do you feel that Gary Gensler and the SEC have done a good job of assisting to increase market integrity and market fairness and protect investors? Let me know how you guys feel about that. Brian says Jay Powell bought me a new computer today with his rate cut put prints. My friend, good job. Very well done. I'm happy to see that because I think a lot of people were well aware that inflation was going to come in hot, CPI. And tomorrow, PCE inflation comes out, and we should have another high inflation reading on PCE. And it's likely that that will increase the price of silver and gold and decrease the price of Bitcoin and the SPY. But again, this isn't financial advice. That's just my guess. Manifest Moon says it's going to suck for U.S. federal employees with no paycheck. I hear you, but I got to say, that the United States federal employees have for very long not had to worry in the same way that regular private sector employees had. They don't have to really worry about getting fired or losing their job or being laid off. Whereas the same can't be said for private sector employees. So for them to actually worry about where they're going to get paid, when they're going to get paid again, or where they're going to get paid is something that the majority of people, non-federal employees, often have to deal with on a regular basis. Yeah, hypolaristic, temporary decrease in Bitcoin. Yes, my friend, for now. Dan, it's good to see you. Ken says it's an oxymoron with Wall Street being fair. Moon and Ed Keylaw and Quant Trades, you guys don't seem to be feeling that the markets are very fair with the SEC in its current standing. And I don't blame you guys in the slightest bit. Because we saw not one, not two. Chancellor Walz, I thought a few hours ago a deal was struck to prevent a shutdown. No, my friends, the GOP came out with a 116-page bill after the initial 1,600-page bill that was put in place by Rhino House Speaker Mike Johnson was shot down after millions and millions of Americans called in and destroyed their phone lines, letting them know that we are not interested in sending more money overseas and blocking vaccine schedules from being changed and many, many other things. So the original 1,600-page bill was shot down by users across America, ex-users particularly, where the real news happens, and here on YouTube as well, where we share the real news. And there is now a 116-page bill that was put out there by the GOP, and only 2 Democrats voted to pass this bill. This bill is very fair. It does not have a 40% increase in salary for congressmen. It does not have all of the bulk related to Ukraine and creating 12 new biolabs that the original 1,600-page bill had. And only 2 Democrats voted yes for it. The rest of the House Dems voted against it. So that gives you a good indication of where the party lines are drawn. So a government shutdown is in fact still on the table. And I looked it up earlier, and Polymarket is showing that a government shutdown is about a 67% chance of happening. Here, I'll show you real quick before I get into AMC and GameStop. I looked it up on Polymarket. Will there be a U.S. government shutdown? Because I actually know, well, not know, but I have a good idea of how that's going to go. And the chances for it shot up to 75% a few hours ago. And they currently sit at a 59% chance of a government shutdown. This is people betting yes or no. You can buy or sell shares on a government shutdown occurring or not occurring. Well, not in America. This is illegal in the United States to use, but it's not illegal to look at. But I definitely do hope that a government shutdown occurs. We can iron this out when the Trump administration is in full swing. Let's put it that way. Either way, a government shutting down really doesn't do a damn thing to the vast majority of people. So we got three badass charts here that were created by somebody named Ringing Bells. And I want to share this with you guys. Brass Monkey, great point, my friend. He says the government employees will get a 2-week paid vacation because if the government shuts down, Congress will pay back pay for chilling at home. I have a family member in the 96 shutdown. I hear you, my friend. So, Apex Clearing's 10 a.m. margin calculation on January 28th, 2021. A lot of people are unaware of this, but this information came from the Congressional GameStop report. Apex Clearing was in big trouble. Big trouble. There were over $430 million just for Apex Clearing in margin calls. They had a $1 billion margin call. That is their total collateral NSCC deposit requirement. And of this margin call, over $900 million of the $1 billion margin call, so 90%, was attributable to 3 stocks. And these are the 3 stocks you hear me mention all the time when I'm talking about this travesty in which millions of retail investors were robbed of the opportunity to make significant gains, and even more so, to lock in their gains. GameStop, 1. AMC, 2. And COS, 3. But not actually in that order. The vast majority of the margin calls that were doled out by the NSCC were in fact due to over-leveraged bets against AMC. AMC more so even than GameStop. Now, don't get offended here if you're an elitist. That's not the point here. The point here is that AMC more so than GameStop was the real threat on January 28th, 2021. And I will go into that into further detail. So you can see here, GameStop, AMC, and COS made up $337,600,000 of the margin call of Apex Clearing alone on January 28th, 2021. The other symbols, about a dozen other symbols, equaled $97,300,000 worth. So that's 78% for these 3 stocks and 22% for the other, about a dozen other stocks that were made position close only. And that means people couldn't buy them. They could only sell them. But institutions could, of course, continue to buy them. So here's the value at risk capital. That was $434,900,000 in value at risk. That's how much they had basically started to attribute it. And then the excess capital premium was pretty much a margin call of $562,400,000 in excess capital premium with $2.7 million in excess fees, miscellaneous fees. So let's take a look at the information from pages 82 and 83 of the GameStop report. On the morning of January 28th, 2021, before the market opened, Apex received their daily automated NSCC deposit requirement notice, which showed a collateral deficit of approximately $68.2 million. That is, of course, well within the means of Apex to satisfy, and accordingly, this deposit notice did not elicit any non-routine reaction from Apex. So this was pretty standard for them. At 10 a.m. Eastern Standard, however, Apex accessed the NSCC's portal and viewed a slice. We're going to call this the 10 a.m. slice because that's what it's referenced as in the GameStop report from the U.S. House Committee on Financial Services. At 10 a.m., when they viewed their slice, we'll call it the 10 a.m. slice, that showed a total potential collateral deposit requirement basically a margin call, that had increased exponentially from approximately $68.2 million to approximately $1 billion. $1 billion. We're starting to sound like Mr. Evil over here. Is that his name? From Austin Powers. I can't remember his name, but whatever. You get the point. $1 billion with a value at risk charge of $434.9 million. While the slice did not include information on a potential excess capital premium charge, Apex calculated that it would owe an excess capital premium charge of $562.4 million more based upon the value at risk charge contained in their 10 a.m. slice. Now keep in mind, this is just for Apex clearing. This $1 billion margin call, if you will, on January 28th at 10 a.m. was just Apex clearing. That doesn't include Citadel, Robinhood, Webull, E-Trade, Goldman, Chase, and so on and so on. You get the point. This is just this one clearinghouse. That gives you an indication of just how big this problem was for these guys. And let me pull up the one for Robinhood, as a matter of fact. Let me see if I've got it on my desktop, because I'd really like to show that to you guys as well. And I know a lot of you guys may have seen this, may have seen me post this graphic before, but I'd like to try to find it if I can, because I do think it's freaking badass. And then you can get an indication of just how massive this was when you start seeing multiple different firms having these margin calls. If I recall correctly, Robinhood's was around 2.2 billion, 2.2 billion. So over 100% larger than Apex Clearing's alone. Let's see where I've got this puppy. So upon receiving, as while I look for it, I'll read this out here for you guys. Upon receiving their 10 a.m. slice, Apex personnel felt that it would be challenging for them to meet a discretionary intraday margin call in the vicinity of $1 billion within the normal 1 hour time frame. Because when they get margin called to this extent, they get 1 hour to pony up, or the firms, the NSCC in this case, can seize some of their assets and fire sale those assets. And that's what they were worried about. So upon receiving what it appeared to be an anomalous slice of data, they thought it was a mistake. They quickly reached out to the NSCC and confirmed that the numbers provided in the portal, the $1 billion margin call, were accurate. And that did not include the excess capital premium charge calculated internally by Apex. So, they figured out it was accurate, it's correct. NSCC confirmed it. And senior Apex personnel, expecting trading activity to increase throughout the day and drive the requirements even higher, decided to impose trading restrictions on AMC, GameStop, and COS. Apex reviewed the detailed NSCC files outlining its collateral charges and estimated that at the time that it imposed its restrictions, for those of you that don't know, its restrictions were basically making these stocks position close only and telling the broker dealers that they were no longer accepting any trades for those stocks, I should say, those equities. So at the time that they imposed those restrictions, pending settlements for these three symbols accounted for approximately 90% of Apex's total potential NSCC deposit requirement, which, as we just discussed, was over $1 billion. Apex's CEO, Bill Capuzzi, approved of the decision to impose trading restrictions prior to the distribution of the emergency notice via email that was sent to Apex's clients. Let me get that out of the way. So there alone, we have $1 billion on there. So that's part one. That's the 10 a.m. slice. Now let's take a look at the next one, part two. Let's take a look at part two of Apex Clearing's 10 a.m. margin calculation. This was after they had made AMC, GameStop, and COS, and about a dozen other securities, position close only. And we're no longer accepting trades or orders, I should say, for these companies from their broker dealers like Robinhood and Webull. They have something called Trade 385. And Trade 385 basically created a temporary imbalance in trading activity, which, for example, is a net buy position, which represents greater risk in a trading book and resulted in the NSCC assessing a heightened value at risk charge to Apex. This means that due to Trade 385, they were forced to buy the stocks. Before I move on down further, you can see here that they still had Trade 385 was over $284 million. AMC, GameStop, and COS was $50 million. And then about a dozen other symbols were $100 million. Let me pull up this information for you guys. So using the most conservative at least values combined with the 90% collateral qualifier here, if correct, Apex lost their risk mitigation as a reason to have placed GameStop in liquidation-only status, but they did so because of Trade 385. Apex claimed that 90% of their total potential collateral requirement was in these three symbols: GameStop, AMC, and COS. And this obfuscated that 85% of their collateral requirement was basically a botched AMC wash trade. If only 12% of their value at risk was in GameStop, AMC, and COS, aside from this, the 90% is a lie of omission in which they didn't tell the full truth. They lied by not telling the whole truth. Check this out. Check this out. So you can see here that their value at risk percentage from 1045 onwards for Trade 385 was about 65% of the total, and 35% was for GameStop, AMC, COS, and other symbols. So here you can see how much was related directly to these three stocks. You know, around $436-ish million. And then they also had this other trade here. They had these multiple different trades and symbols. This was for their margin call at 10 a.m. These was for Trade 385 at 10:45 to 11 a.m. This was what was left of these three stocks. And then this was the remaining stocks on there. And looking at their 10:45 a.m. margin calculation, you can see that Trade 385 that they had, which we believe to be an AMC wash trade gone wrong, showed them with at least values and at most values and a conservative estimate based on the difference in price between 10:45 and 11 a.m. to be $212.8 million for Trade 385 and $112.2 million for all the other symbols, you know, the dozen stocks plus GameStop, AMC, and COS. You can see here now at that time, they had a value at risk of $325 million, a further margin call of $607.9 million, and $127 million worth of fees. Check this out. This is a really great point here from Ringing Bells that I've got to share with you guys. In Apex, NSCC's collateral deposit requirement happened 15 minutes later at 11 a.m. on January 28th, 2021, when Apex finally logged a massive sell trade from the prior day, January 27th, of around $385 million in AMC stock, or a 23 million share sale, that Apex had failed to log but was now acknowledging. However, the event worsens. This lost sell trade was the second half of the same second wash trade by a market maker on January 27th. Now, this isn't the first that we've talked about this, but a lot of people still don't know this. And in my opinion, this isn't speculation. This is factual based off of the evidence that we have and the information that we've been told to in the GameStop report. Apex made a big mistake. They didn't log their sale on January 27th in a way that they should have. There was some sort of an error that they made. And because of that error, the sale didn't go through. It was an after hours thing, like a slightly after hours thing that was supposed to sell, but didn't happen automatically as they thought it would. That caused them a big problem because, as we've said, these guys can control the price until they can't, until something goes wrong, until they get margin called, until the shit hits the fan, until the gamma ramp is too big, until the FOMO is too strong, until too many people are buying the stock, until too many people are buying options on call contracts on the stock. So this lost sell trade was the second half of a same second wash trade by a market maker on January 27th. Same second, he means in the same second. It was a trade that occurred in two halves. The buy on one half of a second and a sell on the second half of a 1 second time period, for example. And the buy happened, but the sell never happened. The wash trade went wrong. So they screwed themselves. The first half of the wash trade being a buy trade of $385 million or 23 million shares that they bought of AMC stock. This was set up to be a wash trade in order for them to dump the price, in my opinion. That's why I think they did it. This $385 million buy trade with the unanswered by the equivalent sell trade that should have also happened in the same second wreaked havoc on AMC stock's volatility, which fake spiked Apex's value at risk formula for AMC stock, making it impossibly expensive to clear on January 28, 2021. But it wasn't really, in my opinion, a fake spike of their value at risk. That actually was their value at risk. Because instead of pumping and dumping the stock price with a wash trade, they pumped it and forgot to dump it. Only half the trade executed. Half of their wash trade executed. So the volatility having the largest effect on value at risk calculations, clearing for AMC reached 118% of the notional value. Apex had to pay 18% more than the customer. Evidenced this trade is the main reason Apex was defaulting is clearly shown when Apex finally acknowledged the $385 million sell trade at 11 a.m. and Apex's defaulting clearing calculation vanished. This is the smoking gun. Apex had an $895 million drop in their collateral margin call, basically, in the 15 minutes when Apex acknowledged the $385 million sell trade from the prior day. Moreover, since Apex's defaulting calculation values were only 15 minutes prior to their now nominal, drastically lowered collateral values, we can safely use the difference in values between the two times to estimate the damage that trade 385 had. That was the failed wash trade of AMC. The name I dubbed this event, these two trades in this argument, caused on Apex's margin. The broader question here is, did this trade affect volatility to other clearing firms as well? Because Robinhood's defaulting NSCC collateral requirements looked very similar to Apex's. If so, then Apex's failure to timely log their $385 million buy in AMC caused the entire clearing and settlement crisis on January 28th, 2021. Both Apex and Robinhood used their NSCC collateral deposit requirement calculations to place GameStop and AMC in liquidation-only status, aka position close only, or stealing your buy button, for retail traders, tanking the value of their stocks artificially. Meanwhile, without trade 385, these clearing firms didn't have a risk mitigation reason to freeze buying on GameStop as AMC was defaulting them. Finally, is that wash trade legal? Who was the proprietary trader who made these trades? Why was it categorized as market-making activity? If anything, it destroyed the market. What market-making purpose did this serve? Wash trades are not legal, period. So you can see here, for those of you that have not read this thing, I've read this stupid thing in its entirety multiple times already. Here's the slice, the 11 a.m. slice. So at 10:45 a.m. Eastern, Apex reviewed the slice of their margin call, of their collateral requirement, indicating a potential requirement of $1.06 billion, largely consisting of their value at risk charge of approximately $325 million, and what Apex calculated to be excess capital premium charge that increased to approximately $607 million margin call. The 11 a.m. slice showed a dramatically reduced total potential deposit requirement of approximately $164.8 million. So they took away your buy button. They finished the rest of their wash trade. And because they took away your buy button, they were able to bail themselves out, right? They were no longer accepting your trades. Let me Google here, look on X real quick. Robinhood value at risk. I know that'll pop up if I search that here. And then I could show you guys just how massive this was, because it wasn't more than the one. Here it is. Posted this in 2022. Robinhood value at risk was $250 million. Margin call attributable to GameStop. Oh, sorry, that's just the value at risk. That's not even the margin call. And $850 million attributable to AMC stock. AMC has always been more of a danger to brokers and short hedge funds than GameStop, as evidenced by the SEC, by the report here from the SEC.gov and the House Financial Committee, as stated. Here on page 52, it says, as detailed in the information that the NSCC provided to Robinhood through the automated portal, the largest components of the company's collateral deposit requirements was a value at risk charge of $1.3 billion, as well as an excess capital premium charge of $2.2 billion, which Robinhood had not calculated. Robinhood calculated that of the $1.3 billion value at risk, approximately $850 million was attributable to AMC, and approximately $250 million was attributable to GameStop. When Robinhood's operational staff first saw the collateral charge, they reached out to their executive team, and then Robinhood employees also attempted to reach the NSCC to verify the accuracy, and eventually they did, even if they weren't able to do it on their first attempt. So you can see here's the graphic. Robinhood's initial margin calculation on January 28th, $250 million at risk for their GameStop trade, $850 million at risk for their AMC trades, $200 million for the rest of the dozen stocks that were made position close only, and then you have $2.2 billion in Dodd-Frank risk deterrent and a $1.3 billion margin call, which was this up top. So you can see that's obviously, $3.5 billion margin call from the NSCC against Robinhood that was due on the morning of January 28th. It is reasons like this that retail investors need to find a broker-dealer that does not route your orders using payment for order flow directly to companies like Citadel and Virtue. That is why you need to go look into litexchange.com for yourself, ladies and gentlemen, because unless you find a brokerage that is not doing these things and is not giving your orders to Apex and is not giving your orders to Citadel to be internalized, traded in a dark pool, front run, and then suppressed, and then failed to deliver, well, why the hell are you even investing your money? I don't understand. I don't understand how people can do this, can continue to trade like that. That's so. Check out Lit Exchange. You can actually have your orders routed automatically to lit markets. It'll protect you from a shitload of forms of market manipulation. You're going to have various artificial and swarm intelligence capabilities in your hands that don't currently exist, because we are creating them. We've been creating them for the last 38 months, and our engineering team is making exceptional strides. We're going to have a bleeding edge user interface, and you can now join the Founders Program. You can view our SEC Edgar filings here on the SEC Edgar website, linked from our website as well, if you don't feel like searching it up on SEC Edgar website. And you can also visit the FINRA-approved funding portal and regulated broker-dealer, Silicon Prairie, here to invest in the company. So far, thousands of users have already joined our waitlist to participate in our Founders Program and bring their assets under management when Lit Exchange launches. There is, of course, limited space. We blew right past our initial goal of $500,000. It has been raised by over 270 retail investors, and we are now coming up upon our stretch goal of $1 million. And so you might as well get in while you can if you're interested in investing in private equity, because when we IPO, you're going to wish you had gotten in at these rates, in my opinion. gonna fucking wish you had gotten it at this price. So you can get a lot of information there. You can see our Regulation CF, Regulation D filings, more information about myself, my partner, and so on. But I'm not done here. I'm not even close to being done with these guys. Kershaw, Lit Exchange will offer options trading as well. Yes, of course. We will definitely offer options trading. The beautiful thing about options is that options always hit the lit market. Always. You know, Citadel and Virtue, they can internalize your shares when you buy shares. They can, and when you sell shares, that means they can give you ones and zeros in your account and then trade them in their dark pool and then never even deliver them to you. And it's called a fail to deliver. And sometimes even if they do deliver, they'll go out in the market, they'll buy a million shares all at once, and it'll make almost zero impact on the stock price, because that's what dark pools are meant to do. And of course, since they have your order and they can take up to 28 days to process it after they've given you your ones and zeros in your account, they've got 35 days before the failures to deliver information comes out. They can front run your trade. They can do whatever they want with your shares. They can rehypothecate them. They can lend them out multiple times. Yes, Dan, Canadians can invest in lit. We have retail investors from around North America and Canada. I'm sorry, North America and Europe and Asia invested in the private equity of Lit Exchange. And like I said, when we IPO, then you will have the opportunity to sell your shares at the IPO price, which it is going to be way fucking higher than what the price currently is. Right now, the minimum investment is $500 for 1 unit, but 1 unit is going to equal many, many shares. That is not 1 share. You're buying 1 unit. And that 1 unit may be the equivalent of 10,000 shares, 40,000 shares, 100,000 shares, for example. That all depends on how many shares we launch with when we IPO. That is not a number that we've come up with yet, because that is not important at this time. Oh, yeah. Thank you very much for asking, Dan. Patrick says, my definition is having enough money to buy property and other things that will produce passive income. Wealthy to me means living off passive income. Yeah, my friend. The idea of passive income is not as passive as most people might think, but there's definitely a way to have income where you can get by with minimally managing it. Hire a property management firm to handle your real estate. You hire a real estate broker and wealth attorneys to make sure that your money, and asset managers to make sure that your money is making you money. So yeah, you could consider that passive income, sure. But I think that a lot of people underestimate, or should I say overestimate, the term passive income, when in reality there still is some work that has to be input there. Quant Trades, I need my lit sweatshirt. I'm trying to rep it. I hear that, my friend. Yeah, that's one of many perks. One of many, many perks that you guys are going to get as a founding member of Lit Exchange. So their Apex Clearinghouse's 10:45 a.m. margin calculation here was absolutely astronomical. The fact that they had this is the real kicker here. It's their internal review at Apex revealed an imbalance of trading activity in Apex's trading book from January 27th, the day before, caused by a single large one-sided trade when a proprietary trading firm both sold and purchased approximately $385 million of AMC. The two trades occurred within less than 1 second of one another. This, of course, my friends, is high-frequency trading. But given the extreme volatility in AMC, the buy order went through, but the sell side of the trade required manual intervention because the price of the stock had changed so dramatically, so considerably, they said here, in the fraction of a second between the buy and the sell order, that Apex had to manually make that, basically give the computer the okay to manually sell it, and they didn't do it. Apex fucked up. The high-frequency trading screwed them. They screwed themselves. There was a mistake, and what happened? Well, next thing you know, AMC and GameStop run almost 2,000%. The two trades, let me see. The two trades occurred within less than 1 second of another, but given the extreme volatility, the buy order went through the sell side, but the sell side did not, because it required manual intervention, which Apex did not do, because the stock price had changed so dramatically in the fraction of a second between the buy and the sell order. Apex's overnight process for clearing trades require manual verification for trades that involve both the buy order and sell order in rapid succession if the spread between the buy and the sell is greater than $10 net. So that just shows you that a stock that was $2 a share running up to $20 a share was not an accident. They got screwed by their own processes, by the massive volatility, by the incredible numbers of people that were buying and selling the stock, and buying and holding the stock, and options, particularly call contracts, because call contracts create a level of gamma and delta hedging that is required by the broker dealers and clearinghouses that nothing else requires. Buying stock is less risky, I should say, not better. Buying stock is less risky for the long term because people could then hold it for as long as necessary, whereas call contracts have an expiration date and theta, which is basically decay over time. But the reality of the matter is that the reason why your favorite YouTubers and Twitter, personalities that many of you no longer see around were telling you don't buy options on AMC or GameStop, the reason they were telling you that, in my opinion, I would guess that a lot of people allege this as well, is because they were likely paid to say, don't buy options, that gives market makers money. When in reality, the opposite is the case. Does it give market makers money? Yes. But then what has to happen? The market makers have to spend more money than the money they received in order to delta hedge themselves. That means buy shares of stock that they can't get their hands on in order to protect themselves from the incredible risk that they're taking on by selling you those options contracts. So this created a temporary imbalance in trading activity, i.e. a net buy position, which means that there was someone bought, however many, $385 million worth of AMC and didn't sell it in the way that, at least not on the Apex side, which represents a greater risk in a trading book and resulted in their NSCC assessing a heightened value at risk charge to Apex. Once Apex's operation team became aware of the need to manually acknowledge the sell side, they promptly approved the trade, but not before taking away your ability to buy the stock, thus doing the same thing with Robinhood, in which Robinhood also took away your ability to buy the stock, as well as dozens of other firms such as Goldman and IBKR and E-Trade and Charles Schwab, and the list goes on. And I shouldn't even say dozens. I should say hundreds and hundreds. Almost every single stock broker dealer, not everyone, but almost every single stockbroker, prevented you from buying these stocks because you would have made a shitload of money and they would have lost all of their money. So, of course, they mean more to themselves than you. So, once Apex's operations team, and their friends, of course, don't care. Once Apex's operations team became aware, they promptly approved the sell side of the trade. The acknowledgement eliminated the imbalance in trading activity, reducing their value at risk charge, and eliminated the excess capital premium charge in their internal calculations. According to Apex, the firm restricted trading in meme stocks for a period of time on January 28th, 2021, after receiving an anomalous slice and based upon an understanding that the firm may be required to pay an intraday charge in aggregate of over $1 billion, including a calculated excess capital premium charge of $562.4 million. Now, that's just Apex. As I just showed you guys, Robinhood had to pay basically $2.2 billion plus $1.3 billion in excess capital charges plus additional margin call charges. Basically $3.5 billion in margin call to the NSCC, and they had to call up, beg for an exception, and weasel their way out of it. And it was so bad, in fact, that they had to go out and go to their venture capital firm. They had to go to Daddy at Sequoia Capital and say, hey, please give us some more money. we're getting margin called. Give us more money or we're going to go bankrupt. And the millions of dollars that you invested in Robinhood are going to go to the trash can. And of course, they said yes. Here's what's up. You can see here that it says this particular trade was from a proprietary trading firm engaging in market-making activity who initiated a near simultaneous buy order and sell order of an equivalent amount, i.e. approximately 23 million shares of AMC long and 23 million shares of AMC short. So, who can there be, what proprietary trading firm could engage in market-making activity with Apex Clearing to initiate a near simultaneous buy order and sell order? A market maker. So it could have been a firm, say, like, Wolverine market making or some shit like that. It could have been Citadel, for example. But why would they do that? It would make sense more that it was one of their own internal firms. It would make more sense that it was one of their own companies. 1 second. Now, Apex Clearing Corporation is a wholly owned subsidiary of Apex FinTech Solutions, which is owned by the fintech firm Peak Six Investments. So they provide clearing and custody services, facilitating trade execution by routing orders to various exchanges and market makers. This approach enables Apex to offer efficient and reliable trading solutions without directly engaging in market-making activities. So it could have been any other firm that was trying to engage in these activities, any other market maker. So there's only a key number of market makers that were actually doing this. It could have been Wolverine Trading. I think that's their name. I think the last name is Wolverine Trading, if I recall. It could have been Virtue, Citadel, State Street, or Jane Street, and Apex could have been their clearinghouse. Now let's take a look at this. Apex Clearing Corp provides clearing and custody services to a diverse range of clients, including online brokerages, wealth managers, firms, professional traders, and consumer brands. I will tell you one thing. Apex Clearing is sure as shit not going to be the clearinghouse for Lit Exchange. Neither are some of the other dark pool loving firms that you guys are very aware of here. Like many others, like Fidelity, for example, we will eventually self-clear trades as well. Now, Apex interview with the Chief Compliance Officer and the Chief Corporate Development Legal blah, 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 have revealed that margin requirements had been increased by the NSCC to 118% of notional value for AMC and 80% of notional value for GameStop by the morning of January 28th, 2021. So even though GameStop was at a higher price, because it started at a higher price, at the end of the day, at the beginning of the day, and at the end of the day, The value at risk charge for Apex, Virtue, Citadel, Robinhood, Webull, and on and on and on and on. All these hundreds of different firms, the broker-dealers, the clearinghouses, the market makers, the majority of the risk was with AMC. And of course, GameStop was not too far behind, about a quarter of what AMC's, no, about a third of what AMC's was. At the end of the day, there's a reason that there's two symbols and two names on this hat, AMC and GameStop. And that is because they are often traded in the same baskets of securities. They are held within the same exchange-traded funds. They are manipulated in the same swaps, the very same swaps that collapsed Archegos. And Archegos founder Bill Hwang was just recently sentenced to prison. And today, actually, he was sentenced last month to 18 years in prison for defrauding people of billions of dollars. And today, actually, he went to court and begged the judge to give him a reduced sentence. The judge says, you're fucked. You're going to prison to rot for 18 years or until you die. Because it's not likely he's going to live more than 18 years at his age at this point. Let me pull this up for you.
GameStop and AMC. Joining us now in a first on CNBC interview, Interactive Brokers Chairman and Founder Thomas Peterffy. Thomas, thank you for joining us. It's great to have you on a day like today to help clarify what
Check this out. You guys have seen this before.
What is going on? So explain to us.
Now I'm going to let you watch this one more time, because now that you have learned everything that you've learned that I just explained to you, you're going to see why the hell the CEO of IBKR was so worried about a domino bankruptcy, because the situation with AMC and GameStop is not over. It's far from over, ladies and gentlemen. It's just on a temporary hiatus. We saw that in May of this year, May of 2024, when both stocks ran up 500-600% in a matter of a few days. Just from somebody putting out a tweet from Roaring Kitty. All Roaring Kitty did was put out some tweets. And that was enough for retail to be like, yeah, you know what? Fuck these banks. Fuck these market makers. Fuck these crooked broker dealers. They took away my buy button. I haven't left. I'm still here. I'm still holding. And I'm going to buy some more. And that's all it took to get the stocks to run 500-600%. And of course, there was then some dilution announced by Ryan Cohen of GameStop. And that put an end to that, because more shares came up on the market. Retail got scared off. And while the majority of people did not sell, as evidenced by the OBV, the additional shares on the market from GameStop there gave these firms enough to buy more to prevent the stock price from going higher. But of course, GameStop is already at $30 a share again. AMC, which was at GameStop a few months ago, before May of 2024, was at $11 a share and is now at $29, $30. AMC, before May 2024, was at $2 a share, and now it's at $5 a share. Both of these stocks still up over 100% from May of this year. And I have a feeling that something else is going to happen here very soon. In 2025, that probably coincides with the Trump administration's new regulations and other issues seen in financial markets that will cause these stocks to go up much more than 500%. Much, much more. Hey, Down Under. Hey, Dan, Stone Cold. Good to see you guys. Check this out. Now that we've talked about this and you guys are more well informed about the billions and billions and billions of dollars in margin calls that these guys faced.
Our audience,
now this is going to make more sense to you.
Have decided, like Robinhood, to restrict trading in shares of these companies. Like, what is going on? So explain to us, to our audience, why you have decided, like Robinhood, to restrict trading in shares of these companies, like GameStop and AMC.
So simply put, we are worried about the integrity of the marketplace and the clearing system.
They're worried about the integrity of the market. The integrity of the market is incredibly worrisome to them. They didn't do this to protect themselves. They did it to protect the market. Sure.
This is a new scenario in which fundamental values do not matter. Stocks that are worth single-digit dollars go to several $100s. For example, Game today jumped up and down hundreds of dollars at a time. We are concerned about the ability of the market and the clearing systems to withdraw the onslaught of orders, to continue to provide liquidity, and we are concerned about the financial viability of intermediaries and the clearing houses. Now,
he said, Apex and the rest of us were going to go broke. They couldn't clear the trades. We all got margin called. We were going to be bankrupt. I was going to lose my billions and billions of dollars. So we had to fuck over retail investors to save our own asses.
I hope that your audience can follow this. For every option trade, there's a buyer and a seller. There are as many long options as there are short options. So when the stock moves either way, some options make money they on one side, and the other side they lose money. The broker stands between his customers and the clearing house. So when some option holders make money, the clearing house has to give us the money to give it to our customers, while other option holder sellers or buyers on their own side lose money. We have to collect money from them and give it to the clearing house. If our customers are unable to pay for their losses, we have to put up our own money. Now, luckily enough, we have $9 billion of equity, so we don't have a problem. And we also have a very well automated risk management system, so we haven't really gotten hurt. However, I cannot say the same thing with full confidence about other brokers. I really don't know where they stand, so I'm extremely concerned.
If IBKR was in such good shape, why did they have to pull the buy button and prevent you from buying the stock? If IBKR was fine, all the other brokers were having problems, but we were fine, so we just decided to pull the buy button anyway.
As Game moved from $17 to $500, there are roughly 3 million contracts outstanding in the options market. If one of those options is worth, say, an average option I estimate worth about $10,000 now, so that is a loss of roughly $10 to $15 billion on the one side and $10 to $15 billion of gain on the other. I'm afraid that there may be brokers who may not be able to meet these margins.
Oh, he's worried about the other brokers.
So that
poor other
brokers. Just to be clear, you're worried about the middlemen. Are you doing this move to protect yourself or to protect your customers?
Partly to protect ourselves, but most...
Oh, now he gave you just a little inkling of truth. Partly to protect ourselves, but we're gonna say it's for you. Okay, remind you, your accounts are SIPC insured up to $500,000 each. If you had, say, invested $5,000 and it was now worth $500,000 or even $1 million, and IBKR went bankrupt, well, the SIPC would still give you your $500,000. So how much are they protecting you and how much are they protecting themselves?
To protect, of course, to protect our customers, but most of all to protect the marketplace. To protect
what a fucking joke. Fucking lying sack of shit, so Thomas Peterffy. You're a fucking lying sack of shit. You should be ashamed of yourself.
$15 billion of losses in there. Mm-hmm. Somebody has to pay them. Will they be able to pay it? It's the big question.
Thomas, do you understand people's anger, your customers' anger, given that essentially you changed the rules of the game right in the middle of the match, at the most important moment in the match, even if your terms... Look at him
laughing. Look at him fucking laughing. What a fucking disgust. This guy is telling him the truth. They literally changed the rules. The rules are buy low, sell high. And retail investors were buying low and selling high. And IBKR, along with Robinhood and Apex and all the rest of these other broker dealers that majority of you are still using, majority of people are still using. Why? Because there's no other options. Guys like Peterffy, guys like Vlad Tenev, guys like Liquidity Fairy Doug Sifu and Kenneth Cordell Bedpost Griffin are the only options until now. That's why we've been working on Lit Exchange for over 3 fucking years. Get it? Do you get it? We are for retail by retail. We don't have to go through these guys. You don't have to put up with this shit. But guess what? They're not going to change. The only way that things are going to change in these markets is if we do them ourselves. And as an entrepreneur and business owner over the last 20 years, having built not one, not two, not three, but multiple 7- and 8-figure businesses, I know exactly how to do that. Because it's time for us to create a 9, 10, 11-figure dollar business. And that's here at Lit Exchange.
Conditions allow you to do that. Do you understand their anger that you changed the terms of trade for them just as things were getting heated up?
I do, but when you say right in the middle of the game, then you're saying as the squeeze is going on, stronger and stronger.
Yeah, that's the fucking point, right? Buy low, sell high. That's the fucking point. That's the game. That's literally the fucking game. You were beating them in Monopoly. You were beating them in chess. They were getting fucking smashed, and it was checkmate. And they flipped the fucking board because they were losing. This is not acceptable. This is the kind of shit that we've seen happen time and time again. Look at other things that have happened, like MMTLP and AMC, GameStop, COS. Look at it. It happens over and over again. Silver, gold, the SLV ETF, the nickel trades that were reversed. How many times does this have to happen? And people see hundreds and thousands of % increases in their brokerages just to get it stolen away from them, for them to people to keep fucking putting up with this bullshit.
But that's illegal. That's manipulative.
It is not manipulative. It is retail investors playing the fucking game. You guys took out short bets that you couldn't make. Apex, Virtue, Citadel, Robinhood, and IBKR sold shares and borrowed shares that they didn't fucking have. And all retail investors did was buy. I said, hey, I'm going to buy some. And you over there said you were going to buy some. And you over there said you were going to buy some. We didn't talk about it. We just did it. Because we saw the prices going up. We saw that we were correct. And then Melvin Capital comes out with 140% short interest on GameStop. And people bought some more GameStop. And then AMC goes from $2 to $20. So they bought some more AMC. Buy low, sell high. But that's market manipulation, according to Thomas Peterffy.
So it cannot be done.
So do you think...
Also, I think, somewhat responsible for what our customers are doing.
Yeah, you guys are responsible for stealing from fucking retail. Here, you show just how fucking scared he was. He's a fucking chicken shit.
Thanks for joining us. My first question is, are you surprised and or disappointed not to be a part of the hearing tomorrow?
Oh, no, I'm neither surprised nor disappointed. This is just fine with me.
Just fine. I can imagine. So
Bacon says, boss, when Lit Exchange starts and we transfer, do they have to transfer your real shares? Yes, when you transfer in your shares of any stock, AMC, GameStop, Tesla, whatever, you name it, yes, they have to go out on the market if they don't have enough shares, buy the fucking shares, and transfer them to us. Yes, they fucking do.
What do you think will be the focus? Because there's lots of angles here, whether there was insider trading, whether the likes of Robinhood hurt their customers, and whether the likes of Citadel are abusing their power. What do you think is the key focus and the likely outcome?
So what I would like to point out here, that we have come dangerously close to the collapse of the entire system, and the public seems to be completely unaware of that, including Congress and the regulators. So let me explain to you that on January 26th, Game had closed at $77 a share. The following day, it closed at $148. The following morning, on January 28th, the stock opened at $355 and traded up to $480. At the same time, Game had 50 million registered shares outstanding and a short interest of 70 million shares. In addition, there were about 1.5 million calls, which would call for 150 million shares. If the longs repay their margin loans and exercise the calls, their brokers would have been obligated by the rules as they are today to deliver to them 270 million shares, while by only 50 million shares existed.
Basically, there were so many options out there. There was only 50 million shares available, 270 million shares worth of call contracts and shares that needed to be given to retail if you guys had exercised your options. And we were screwed. And I'd like it to be known that he mentioned how high that sale price went. Yeah, he said the sale price went to $300 a share. I want you to see how much fractional shares we're going for. This was somebody who sold 0.54 shares of GameStop at a market order. A market order means it sells at whatever the price is at that very moment, regardless of whether it's $1 or $1,000 a share. This was at January 28th, 9:34 a.m., literally 1 minute before they removed the buy button. The buy button of GameStop and AMC were removed at 9:35 in the morning on January 28th, 2021. And the reason they did that, because at 9:34, somebody sold half of a share of GameStop for an average price of $5,124.50 a share. They then canceled after that, because the stocks became position close only. The other order that they had placed for one share was canceled. The firm said, we just lost $5,124.50 a share for half of a share of GameStop. We just gave somebody over $2,600 for half a fucking GameStop share. Not even one whole share, half a fucking share, ladies and gentlemen. And the firms realized we're fucked. That is how I can be so confident in saying that $10,000 a share, $50,000 a share, $160,000 a share is not impossible. It's improbable, but it's not impossible. At the same time, here's somebody else. They bought $160 worth of AMC using a market order on December 14th, 2021. Now, granted, this is almost 11 months later, but their shares, 0.66 shares, were purchased for $13.87. Half of a share was purchased for $13, and 146 remained unfulfilled. Because at 9:30 in the morning, when the market was wide open, Robinhood couldn't even get one fucking share of AMC. What does that tell you? Why do you think they're so heavy into the dark pools? Let's go back to Thomas Peterffy so you can see how fucking terrified he was.
So when the shorts cannot deliver the shares, the broker representing the longs must, by the rules of the system, go into the market and buy the shares at any price, pushing the price into the thousands.
So basically, when the shorts can't deliver the shares, we as the broker-dealer, because we're not holding the amount of shares we should be, have to go out and buy it at any price. Therefore, we got scared. We were going to lose our asses, so we took away your ability to buy.
So as the price goes higher, the shorts default on the brokers. The brokers now must cover themselves. They push the price further up. So the brokers default on the clearing houses, and you end up with a complete mess that is practically impossible to sort out. So
basically, he's saying shorts were fucked. We were fucked. The clearinghouses were fucked. Retail would have made tens of billions, if not hundreds of billions of dollars. And of course, the elite can't let that happen. Well, not as far as they don't think they can. But eventually, things have a way of working themselves out. So one day it'll happen.
What almost happened. To avoid this in the future, the SEC needs to immediately call for reporting of short interest on a daily basis, because they are currently only reported twice a month. And I think they should increase margin requirements on shorts by 1% for every percent of short interest. That would solve the problem. This is a gaping hole that didn't had before, because short squeezes are considered market manipulation, which is illegal. But so therefore nobody did it. But with these social platforms, people can just chit chat and suddenly a short interest emerge without pointing at any one person who is guilty, right?
So Thomas, I mean, it's extremely complicated, and they'll have to try to explain all this market structure in between some of the populist grandstanding from members of Congress tomorrow. But ultimately, who are you saying is to blame, if anyone, for what happened?
No, it's nobody. Nobody is to blame. There is a hole in the system that we immediately have to stop. There's a hole in the
short interest reporting.
Short squeezes. Sorry.
You're saying that is the short interest reporting. That's what was happening here. That was the problem.
No, the problem was that there is no increased margin requirements on shorts as the short interest increases. As a matter of fact, most people don't even know what the short interest is, because it's only reported twice every month.
Look, at least he's saying some things that are truth. In the midst of his lies, he's telling you some partial truths. And he is correct in that. He is, of course, trying to obfuscate the reality and hide the fact that, well, we were screwed because we lent out shares that we didn't have. And we rehypothecated the same share and lent out the same share to 5, 6, 10 different firms. And they couldn't buy them on the open market because the prices were getting too high. So they were defaulting like Archegos defaulted on their prime broker, their bank, Credit Suisse. Archegos, of course, went bankrupt. Credit Suisse went bankrupt. And they had to get bought up by UBS. Now, UBS is fake. In order to buy them, UBS had to get the Swiss government to agree to give them $8 billion if they incurred over $4 billion in losses, which, of course, is going to happen. It's going to happen. It just hasn't happened yet, but that's coming. Mark my words. Write this video down. Bookmark this video. Save it. Because one day in the near future, you're going to be like, that fucker was right. Bostradamus was right.
Portion, Thomas, of your trading is payment for order flow. I know it's a smaller percentage than some of your rivals.
It's like 3%.
I don't believe the guy in the slightest, because IBKR makes money just like the other firms by using payment for order flow. There's other ways that they could route their shares, but they route their shares to the highest bidder. And Citadel and Virtue and companies like that, market makers like that, pay the most for your orders so that they can do all of the things that we've talked about. Front run your trades, internalize the orders, fail to deliver, and make money off of you, and then wash trade these shares over and over again to bring the price down. Wash trades are done to bring the price down of stocks. Wash trades are done to manipulate markets. Wash trading is illegal. But they're not going to stop. The only way we're going to stop them is by not giving them our orders anymore. And the only way that's going to happen is if you use a broker-dealer that does not subscribe to giving Citadel and Virtue and other price-distorting dark pools your trades for a fraction of a penny more than the NYSE or the NASDAQ or IEX or other lit markets. Because your trades could still go to other lit markets. It's as simple as that. Avoid payment for order flow. Avoid dark pools where prices are greatly suppressed and retail trades are front run by hedge funds, high-frequency traders, and smart money. Period. Period. You need to check it out. Go to litexchange.com. Fill out the poll. Let's see here. See, Rob, I think if you just joined the chat, my friend, you probably have to rewind a little bit to kind of get caught up on what exactly we're talking about, because this is information that the vast majority of investors in GameStop and AMC don't actually know. And I've already, we've spent about an hour and 14 minutes going over it already. So unfortunately, I can't really, fill you in on everything in a minute, since we've been talking about it for over an hour and 14 already at this point. But I do appreciate that you're here, C. Rob. And I think you should definitely check out the rest of this video, my friend, because it is imperative For a lot of people that don't understand that, Apex was fucked to the tune of billions of dollars. Robinhood was fucked to the tune of billions of dollars. Citadel and Virtue and IBKR and all of these other firms, you name it, they were screwed. They were screwed. Plain and simple. Let's see. Is Thomas Peterffy helping himself or you by removing your ability to buy stocks during volatility? He's helping himself. Plain and simple. All right, ladies and gentlemen, I don't want to take this video too far, so I'll just a super quick poll right there. Thank you guys for voting. Thank you, ladies and gentlemen, for being here with me. It's getting late. It's deep into the morning hours, but I urge you, if you're just coming to this video for the first time, that you definitely should check it out. You definitely should watch it in its entirety, because trust me, you're going to learn a thing or two or three or 10 that you didn't already know. Hakan says, when Mazda. Cheers, my friend. Hey, thanks again, all of you guys, ladies and gentlemen, all of you moderators, Lit Exchange founding members, all of you, you are my fellow partners in Lit Exchange, and I look forward to working with you here in the near future. Yeah, Four Horsemen says, can you imagine Lit being the catalyst? That would be fun. That would be nutty. You know, I definitely wouldn't be surprised if simply millions and millions of shares funneling out of other brokerages and into Lit Exchange were some sort of a catalyst in the situation here, only because I know that so many broker dealers are lending out shares and borrowing shares and rehypothecating shares, and to the point of that they have barely a tiny fraction of the shares that they should have available of these kinds of stocks like AMC, GameStop, and other heavily shorted equities and exchange traded funds and products. So in reality, it wouldn't surprise me at all. And as part of Lit Exchange's business plan, we aim to report the number of shares that are held in our brokerage by our customers collectively for heavily shorted equities. So we will be reporting weekly, say, we have, 80 million shares of AMC in our custody from our customers. We have 60 million shares of GameStop. We have 70 million shares of stock, and so on. You get my point, of heavily shorted equities. Tesla, 40 million shares of SLV ETF held within Lit Exchange. And that will give retail investors a real indication of how many shares are held within just one brokerage. And one can then come up with their own conclusion as to how many shares they think are held at the other brokerages, the hundreds of brokerages that exist in the world. I think that would be extremely important and really do a great deal in assisting people with understanding, achieving real transparency in financial markets. So yeah, thank you, my friend, to all my friends in Sweden, Europe, America, Canada, Asia. Cheers, all of you. South America as well, and Africa. Won't leave you guys out. Let's go. Have yourselves a great night and a beautiful morning. I'll see you in about 6 hours. I'll be back. Larry Garcia says, I'm moving all my stuff to Lit over to Lit as soon as y'all launch. Yeah, my friend, you and a lot of others, thousands of others are already signed up to bring their assets under management at Lit Exchange. And I am very much looking forward at sharing this product, because this is more than just a brokerage firm. This is a fintech company. We are a technology company that just so happens to be launching a brokerage in order to give you guys an opportunity to really focus and do your due diligence in a way that has never been done before. Cheers.